panelists. We're going to try and get everybody up on the screen here, but I know most everyone's interested in the data. So we've been covering the private markets now for 25 years, and we're excited to announce that the J.Thelander survey tool actually has gone in-house for the first time. And so the ability to, have everything internal and the security is higher, and you'll be able to participate in surveys and see where you are. Your data will only have to be entered once. So we're really super excited about that. After follow up from here, we're going to send you a link to the recording here, and also to be able to see your stuff on the J.Thelander survey tool and the survey. So without further ado, I'm going to jump into some of our background here and try and remember to go slow. So we're running now surveys all year round. I think that's the biggest part of what's changed here also, is we know that compensation is not necessarily on the same calendar year for everybody, and that you have hires and changes with your financing. So the private company survey now is updated on a monthly or bi-monthly basis with new data. We also have salary increase and bonus information, merger and acquisition, change of control and severance, outside board member comp. And we have partnered with Mark and his colleagues over at Wilson Sonsini for decades, and they continue to give us content for questions, which is great. And then the reason why Gabby and Christine are here is Christine is, I think what you'll see from this, is a very holistic approach to compensation. And that while the numbers are great to have, they're only as good as you know what to do with them. And that's Christine's expertise, is making sure you know how to do your planning strategies, looking at valuations and understanding what that means for what you own and how you own it. And then Gabby's going to touch on what's going on in the talent market today, how things have changed, people going from private to public companies, public to private. And also we have some updates, as you well know, on the pay transparency and what states are requiring, which Mark will give us some expertise and guidance on how that may affect you as a private company. Listed here are job titles by position. So we cover all the way from CEO, VPs, directors, and staff level jobs. And I think now more than ever, and maybe Gabby, you could touch on this for a second, there's a lot of movement between life science companies and tech companies. There are people who have high level of expertise in artificial intelligence. Robotics companies are hiring people from the tech sector, life science people, there's crossover. Gabby, maybe you could tell us a little bit about what you're seeing from the talent pool, which the high level of expertise you're seeing in the competition.
Yeah. I mean, what you started to say was, with data and analytics, and there is some crossover between tech and biotech these days, maybe a little bit more than in the past. That is definitely a trend we're seeing. And we're also seeing a move from public to private, especially in biotech, given the valuations, the public valuations where they are. A lot of folks are underwater and therefore willing to move to private companies, but the private companies do need to be well funded by credible investors. And we are seeing
good. There we go.
Should we?
Hi everybody. There we go. Nice work. Okay.
We're on, yeah. So there are a couple other negotiation trends that we're seeing people kind of work into their agreements, which we can get to later if you want to move into that a bit.
Yeah, so this is just by way of background with the data. It's so interesting to me, and Mark, maybe you want to comment on this. We used to be 80% life sciences, and now we're sort of almost half life, little more half life sciences and almost half tech. Tech is really, tech companies, healthcare, IT, it's moved into a little bit, moved into quite a bit of a crossover. So what are you seeing with your clients?
Yeah, I think Gabby touched on it a bit in that, life sciences, we used to think of as therapeutics companies, maybe even just like small molecule companies, but and med device, med tech as well. But this kind of whole category, some call it healthcare IT, some call it digital health, bioinformatics. I mean, it's kind of the data focus and artificial intelligence aspects of drug development has created somewhat of a crossover. So it's a little bit hard to kind of put things in clearly in categories anymore. But
And I think that's so important because, we look at comp data by industry sometimes. And for those of you that are on the hiring mode or looking at compensation, that's actually one of the beauty about the J.Thelander platform is you can pick industries, but you can also not pick industries or blend industries. So I would encourage you when you're looking at compensation to be mindful of that. Here's my favorite slide on total financing raised to date. And we've seen, Christine, maybe you can impart some of your expertise here. I mean, the financing categories, even today, are still, while some of the dry powder has dried up, investing is not as these small rounds anymore. We're seeing the private market staying private longer. So that 200 million plus category of private companies sitting has actually grown.
Yeah, I mean, I don't think that this speaks for itself. I think the biggest piece is just it's no longer by like any series rounds. It's really kind of lumping it into the total amount raised, which I think is a really important component because companies are definitely staying private longer. And I think given what's going on with the market, they will be private for a lot longer, unfortunately, right now. So I think that that's kind of the data piece that we need to have as you're looking at all the different comps.
Yeah, so we collapse. I mean, when we're doing consulting for clients, we look at sometimes the under 15 million and the 15 to 50, the 50 to 90, the 90 to 120, so the categories, are no longer in these smaller buckets, although we still survey it so that we can collapse some of them. And then primary location of the company still within the United States and then within the 91%. And, we do see some geographic differences globally, but that really is dependent upon the job title and the value of that job and the competition for that job, and not specifically just everybody in Northern California is making more or the Northwest is really, and Gabby, share with us your experience with this as well.
I mean, for biotech and pharma, obviously the action is still in the US with, obviously the main hubs being Boston, San Francisco, San Diego, Seattle, North Carolina, Colorado to an extent as well. We are trying to see, we obviously do significant work in pharma and biotech in Europe as well, but
are you seeing the differences consistently on where the people are located, or is it really just dependent on the role, the person?
With talent, frankly, the companies that are being most flexible with location are getting the best people. People do not want to relocate anymore.
Yeah, right. They don't really have to. Okay, so here's a little bit on recession planning. This is a preview, so you can see this is our year-end survey, which is now open. So we have just a snapshot, still some nice sample sizes on, are you planning on freezing hiring due to a potential recession? This is private companies again, and 79% saying no. And then any layoffs, so we've obviously seen in some big companies, there's quite a bit of layoffs going on, that 98% are saying no. And I think these are good factors and drivers as to where we're headed. And then hiring, yes, for private companies. And then the hiring from 2023, again, this is a preview from the year-end merit increase option pool and bonus survey, which is now open. And this is, are you intending to hire in 2023? And this is by financing. And you can see these later stage companies very much in line with the fact that there is going to be hiring, and how many key hires you're going to make, somewhere in the order of 1 to 10, which makes sense. The private companies are not going gangbusters. So let's get into some of the compensation here. So this is how many key hires will you make of the less than 50 million in total financing, and then the 50 million plus in total financing. So the younger companies are also aggressively hiring, I think, as you would guess, probably these very key employees. Let's get into the comp here. I'm going to move past this right now. Okay, so these are all kinds of questions that we have. All right, I'm going to move into the executive compensation. The traditional levers are base pay, current bonus, which means it's a bonus that we've tracked that you've actually received, target bonus, which is a projected bonus going forward, and then total cash, which can be a combination of base pay and the current bonus, or it can just be base pay. Not everybody has a bonus program. And then the 3 different areas of equity or founder shares. And Mark, I know we've touched upon this, but that tricky one to define what a founder is, right?
Yeah, I mean, I think you do it well here on this slide. The misconception is that founder shares might be like a different type of stock, but usually it's just common stock that happens to be issued to a founder. And by founder, it's usually the people who are at the beginning of the company that get the, before you even do any type of valuation, you're getting some type of stock at a very low price.
Right. And then what we have here, the founder share for current job means, okay, you get rid of the founder, CEO, or chief medical officer. You got those early grant awards. And then you have now additional equity because you are either fully vested or that number's been diluted and you need additional equity because you're a current role. And then the non-founder shares is for the person coming in outside, who's been hired into the company. So without further ado, let's look a little bit at a biotech CEO comp. And you can see we showed you median, 75th, and max. I'm a big fan of showing the median, 75th, and max because what we've seen happen with our year-over-year data is that the 75th and max numbers have grown. The average and the medians have stayed pretty consistent. It takes a lot of data points to move those. And the reason why the base pay and the bonus doesn't equal total cash, that's a question that always comes up, is there different sample sizes? So not everyone is getting to their total cash from a combination of base and bonus. Some people just have their base pay. Maybe Gabby and Christine, you want to jump in here and talk about this a little bit. I mean, Gabby, how much are you seeing at the private companies where you're doing search work for that there is a bonus set in place ahead of time as a target, or are the executives more equity driven, or what are you seeing today?
Yeah, well, my reaction to this is that this actually looks low to me. I think it's because it's the under 15 million in finance raise. So these are the
let's move up to here's a 15 to 50. So maybe that looks a little better.
Yeah. So honestly, we're seeing the comp range for private company biotech CEOs be more anywhere from 425 to 6 for base. And we're seeing almost to get the best people, you actually have to have a target bonus as well, from anywhere from 30 to 50%.
Yeah. All right, so Christine, this is your client coming in. Gabby's brought them in and they've hired us to do their comp work. And now we bring you in because you have to help them plan. So what does that look like? You're on mute. Christine, you're on mute.
Sorry.
There we go.
As you were going through the types of equity, it actually brought to light just the real need for executives, not founders, but executives, to really understand what they own and how they own it. Because it's, and Mark can jump in on this, but usually it's being granted in terms of options, and options that will vest and have a strike, and that equal kind of your equity package. But again, sometimes it is, if you're early on, you can, be part of that share pool. So I do think it's really important to really understand what you own, and then the way you own it. And, there's a bunch of different tax implications based on what you're being granted, how you're taking your package. And that relies on both the vesting as well as whether you decide whether or not to early exercise your options. And there's a lot of tax implications both on the front end, but then on the long term, from a benefit standpoint, but as well as risk. So really making sure you understand what is available to you, I think, is really important, as Gabby is kind of helping you negotiate what your package looks like. And then it's really up to you to then say, okay, based on what I'm going to be receiving, how do I optimize for taxes and for my ownership?
Well, the biggest thing here, a couple of takeaways from what you're saying, Christine. So let's break this down. Number one thing is that if someone gives you an offer and tells you the number of shares, you need to know the percentage of shares, because a number of shares doesn't really help explain where you stand in the big picture, because you don't know what the total number of outstanding shares are. So that's how we come up with these percentages. And then Mark, if you would jump in and talk to us about the 409A valuation and how that helps you understand sort of where you come to Christine to talk about this, what's your starting point in terms of value, and then if you're going to purchase the stock.
Sure. And as Christine mentioned, when you come in, you at this, let's just take this one for example, in this range of having raised this much money, it's probably a higher valuation company. So let's say it's $100 million valuation. If you come in at 5%, the reason you're likely to get options rather than stock is if you come in at 5% of $100 million value company, then you basically are getting paid stock for your expected services, and the IRS views that as just like cash compensation is taxable. So that's $5 million worth of equity. Instead, you'd probably get granted an option that that may vest over time, that has maybe a $5 million total exercise price, but you don't get taxed on that now. You get taxed on any gain. That's probably, I could go into more detail about incentive stock options, non-qualified stock options, all that, but that can get in the weeds.
We can get into the weeds at a certain point, because I do think it is important to understand the difference between ISOs instead of stock options and non-qualified stock options, and the tax implications around both of those, as well as kind of what you can do there. But I also think it's really important, as Mark said, right, that you don't, there's so many CEOs that I talk to that say, okay, I have shares. I have shares. And if you haven't exercised those, you don't have shares and you haven't started that clock. And so there is a nice cushion to when you start that clock, where if you start the clock where there is no spread, there's no taxable income. But usually that happens as an early exercise. So when you're doing that, the IRS deems that there's no tax, but you are taking the risk because you've not vested fully in it. So you then have a risk of forfeiture. So I do think that trade-off is important. But for any of these companies that do qualify for that qualified small business stock exemption, which is still there, and really allows you to, up to that first $10 million of gain, eliminate the federal tax. And if you don't live in California, you don't have California tax. And there's some really creative things you can do with that around both your personal income tax as well as gifting for future generations, where you can really take advantage of that. But there is a trade-off. So that's why it's so important to really understand what you own, how you own it, and the risks and the rewards for taking on some of that. So, again, we can dive much more into that, but I won't. We should probably get back to the data.
Yeah, but I think that's really important. We always come out of these webinars saying the same thing, that you can see why we're all here, because it is very holistic, and it's not just the numbers. It's also, as you always say, what you own and how you own it, and also the legalese around it. And with Gabby's, resources to make sure you negotiate the best compensation. We've had a couple of questions regarding, aggregate changes in base compensation from our data from year over year, and also someone is suggesting the compensation is much higher on the coast. And do these numbers for non-coast companies? And I think, Gabby, that's what we had really just said. First of all, it's not accurate that the compensation is much higher on the coast. The compensation is high for good people, and talent is being compensated regardless of where they are. And our data shows this consistently, is that there have been very strong areas in the market that are not on the coast, and that it's true, like right in life sciences, that areas where there are academic environments, but there is also many Midwestern states where compensation is very high because there happens to be a public company or some other, competition for that same level. So that's not a consistent across the board that the coasts are the only high place. And it sounds like you agreed with that, Gabby, but would love to hear from you on it.
Yeah, I mean, in our research, it's really about the talent and the person rather than exactly where they're located. So we are seeing not meaningful differences between the coasts and other places.
Yeah, exactly. And then also to answer your question about, an aggregate change in base, so you can see we don't really look at just base. It's got to be total cash, because it really doesn't matter how you get there, if it's a combination of base and bonus, or, total cash is just base pay. But we did do this analysis of median total cash by region. So you can see the Midwest is up and the Pacific Northwest is up. And I think that speaks to exactly why people have the ability to be located wherever they want now. But this was always true. Our data always showed that region, it was not consistent for every single job. I'm going to back up a little bit. Here's industries where median stayed the same, in diagnostics and healthcare IT. So you can see it's very subject to the analysis, and it's just not consistent straight across the board. Digital health and fintech, And also, we had a question here. I'm going to look here, CEO. Here's the gender. I'm going to move. Let's look at tech for a second, because I know we've got a mixed audience here as well. So here's the tech under 15 million in financing raise. You can see that the tech, the non-founder equity, and the founder equity can be very high, right? And the total cash tends to be a little bit lower, although the max numbers we have seen, that is where the change has happened, is the 75th and max, as I said, have gone up. And then here is the next level of financing in the 15 to 50. And you can see that the max number is still hovering the same. The median is at the 275, and the equity obviously is getting diluted. Now, we did have a question, which I think is a great one, about how does non-dilutive funding factor into the fundraising bracket. So when we consult, if a company has raised non-dilutive capital, like they've done something with a corporate, or they have some kind of strategic alliance, what we do is we count the total financing as it relates to somebody's total cash, because the total cash tends to be higher if there's more money that has been raised. And I hope I'm saying that in a way that makes sense. So the more money you raise, even if it's non-dilutive, that should factor into your total compensation on the cash side. You don't, however, include that on the total amount of financing to look at your equity, because you should get, some credit for the fact that you've raised less dilutive capital. And so if you've raised $30 million and that is venture money or money where they're taking a piece of it, and another $20 million, it's non-dilutive, you don't include that in your total financing bracket when you're looking at equity. And Mark, of course, would love your thoughts on that as you're doing maybe an employment agreement, or for someone like how would you look at that?
Yeah, I think where I see that most is in life sciences, and in particular biotech, where there might be some SBIR funding, right, where somebody will get a grant from the government for being a small business.
Right.
And as you say, that factors into what really the valuation of the company is in terms of dollars in. So the way I see that affecting companies and their ability to raise, and kind of what you consider A or Series B, is that they're farther along because they've gotten more money non-dilutive to them, and so by the time a Series A investor comes in, they may have a much higher valuation. And that goes directly to your point about amount raised is probably more important, including this, than whether you're a Series A or a Series B or whatever you may want to call it.
Yeah.
So Mark, sorry, just before we jump into this next section, is while we're on the topic of valuations, just what are you seeing in this current environment, Mark, in terms of kind of valuations, repricing, dilution, and how are companies thinking about this currently?
Yeah, it's a good question. It usually private companies, they reflect the capital market valuations to some extent, and capital market public company valuations are down. It's more difficult for companies to raise at the valuations that they were raising at, pre-money valuations that they were raising at a year or two ago. And how that impacts the companies is if they've raised enough money now, then you saw in the slides are continuing to hire. They don't think they're going to be doing layoffs because they already have that in the pocket. To the extent that they have new financings that they need to come on board, those are going to be on worse terms at lower valuations. Companies are going, we mentioned 409A before, companies are getting lower valuations, and they may be thinking about, hey, my employees, and maybe myself as a founder, my exercise price on any options I may have is underwater now. And so companies are starting to look at repricing those options and getting them back down to current valuations.
Yeah, Gabby, jump in.
Yeah, I was just going to build on that and say that there are a couple other trends that we're seeing, especially with regard to CEO searches and negotiations for private companies. One is there are some CEOs that are negotiating accelerated tranche, to pulling down of a tranche, just frankly to reduce risk in them joining, as a condition of them joining. So if there are VCs on the line, they probably are not going to like the sound of that, but we've seen a few CEOs be successful in negotiating that. And then Others are negotiating an equity kicker based on milestones, either more financing raised or a clinical milestone. And so important to understand that from an equity perspective.
Yeah, I mean, we had an article in Term Sheet and on valuations and how it impacts compensation. And what we're seeing, why you should stay away from valuations and look at total financing. I think that's the biggest takeaway. If I can impart any consistent wisdom here, is to really make sure that you look at the broadest factors in terms of compensation, looking by your total financing raised, and then either your industry or a mix of industries. Obviously, if you're, a biotech company, then there are certain jobs that are just biotech specific. But if you get into finance or operations or HR jobs, it could be across other sectors. It's important to look that way. But valuation has always been a slippery slope. And I know, Christine, this has come up a lot. We've had many discussions on this, because what happens if your stock is underwater, and how does that, if you come in and a company is telling you that your stock is worth a certain price. I mean, we had this discussion in prepping for the call, Christine and Mark and Gabby and I, just that you can't hang your hat on that, right? I mean, Mark, 409A valuation is an indication, but it's not a guarantee.
Yeah, and not only that, I mean, the 409A valuation is intentionally different than what an investor may come in and give you as a pre-money enterprise valuation. It's a 409A valuation is specifically the discounted value of one single share of common stock, without regard to or discounting for lack of marketability, lack of control, all of that.
Right. And I think that's the biggest piece here. I mean, we're going to talk about equity grants in a second, but the reality is that, again, what Christine said, knowing what you own and how you own it, and then also where you are in terms of making sure that you keep all those buckets full, right? If you're going through, like Gabby, what you're talking about in negotiations for someone coming in, it is very important to understand the total financing, making sure your percentages are right, because as you go through more rounds of financing, you get diluted. And it's very hard if you've left yourself at a deficit and you don't have what's competitive. And then further to that, when you get to throw in the liquidation preferences, right? And let's look at this in terms of equity grants. Maybe Mark and Christine, you could talk to Mark. Why don't you explain to us and Christine what the best you can in terms of each of your areas of expertise on the different types of equity awards that you can grant.
Yeah,
Mark, you start.
Yeah, I'll take the first cut at it. So kind of the first two options, both stock options are both kind of have very similar terms. The difference is whether or not they get the benefit under the tax laws of being what are called incentive stock options. And with an incentive stock options, generally you have to be an employee. You can't get them as a consultant. You have to hold them for at least 1 year after you exercise and 2 years after the initial date of grant in order for you to get the benefit. But once you get the benefit, if you continue to get the benefit, incentive stock options, basically there's no tax event upon grant. When you exercise, there's also no tax event. And at the end of the day, if you hold it for the required holding periods, then it's all capital gains treatment on the spread between what you sell it for ultimately and what you paid for it on exercise. Non-qualified stock options, in contrast, when you exercise, there is a tax event, and it's ordinary income on the spread between the exercise price and the value of the stock at the time of exercise. And then later, when you sell it, there's capital gains treatment, but it's on that smaller amount, the difference between the value when you exercised and the price you sell at. What people don't think about, and the Christine maybe can comment on this, because this is the part that requires some planning, is people don't realize that, well, most exits are going to be an M&A exit probably, right? So
Right.
You probably haven't exercised and held for long enough at the time of that. So you think you have incentive stock options, up comes an exit, you get paid basically the spread, and that spread is all ordinary income because you didn't exercise your options earlier.
Right.
RSUs and restricted stock awards. Sometimes people get those confused. RSUs are kind of like it's not a voting grant, but it's basically you'll get the benefit of the increase in stock. Restricted stock award is actually that it's a award of stock.
Not used very frequently in private companies, as you can see, and we don't really see it very much. I know it comes up, but I'm going to jump in.
And with
Actually,
restricted stock units, if you're a private company, upon vesting is a tax triggered. So usually what you see is a double trigger or a double vesting, however you kind of want to phrase it, but it'll be a time-based vesting and then a liquidity-based vesting so that the employees don't get hit with a tax on something they can't pay that isn't liquid. The other piece that I would just add in there to what Mark went through is there is, you only owe tax on the spread for ISOs if you're in AMT. But if you're actually exercising a lot of non-quals, it pushes you out of AMT automatically because it generates a ton of ordinary income. So there is actually almost like a free opportunity for you, even though there's a cost of exercising your ISOs, where you can actually exercise a certain amount of ISOs while staying out of AMT and not owing any tax on that spread. So that's also another analysis that we often do for our clients to just help think through if we're going to be exercising non-quals for whatever reason, then we should probably look at getting the clock going on our ISOs as well without paying tax on that spread.
yeah, I mean, again, Christine, your expertise always makes me smile and remember that I have to really listen to you because it's very tricky. You make it sound very easy. And I just really, I ought to make sure you got advice.
Mark, can I have a tax party?
Yeah. I'll bring the champagne. Okay, so typically vesting in equity is yes, 4-year vesting, time-based vesting, 4-year vesting, 1-year cliff, and also even for new hire shares. We did have, and then post-termination exercise. We're going to skip over this because this isn't as prevalent right now. But the one thing I did want to talk about is, I'm not going to go, I know everyone's going to have whiplash, but we did have a question come up and I think it's really important on the option pool. And it is important because we have carve outs, hang on, option pool. Okay, sorry. So the question came up and I think this is happening now and very relevant to what happens if, you know, someone's stock is underwater, you've got to give more additional equity, but you don't have it. So, and Mark, I know that you and your folks over at Wilson have been great to give us content for these questions. So let's talk it through a little bit. So the total percent of ownership comes into the founder shares, employees, board members, meaning outside board members, and then investors. And basically what happens over time is that the founders go down, the investors go up, but the employee pool you can see is hovering, you know, still consistently, I would say safely around that 15% is a good number to go for. And this is biotech and then early stage, you know, it really doesn't matter. That's what we wanted to show you here. And just as an aside, by the way, I know I'm moving quickly. I also know that everyone loves the slides and we're certainly happy for you to, you know, if you have a picture of this, but if you would appreciate that we do have our copyright on here and nothing should be posted or shared. We're very strict on that. Got my lawyer on the phone, Mark Fitzgerald here, who corroborates that these can't be posted or sent around, please, just a friendly reminder. And here though, I think, Mark, if you could talk to us about what happens, right? Let's say someone needs to be re-upped and there isn't sufficient in the option pool. So what are these buckets that somebody should have been doing of the reserved ownership here?
Yeah, so you know, one thing that's not intuitive that people should know is that when there's a new round of investment coming in and an institutional investor, there'll be a negotiation about how much available shares you should have in the pool. And the reason that's a negotiation is because the investment will come in and the norm is for the investor to say, okay, well, increase the pool before I come in. So it dilutes everybody else but me. And then we'll have enough going forward. How much is enough going forward, and this is part of the discussion and the argument, is how long will that money last in that round? And typically people look at that as about 18 months. So the thought is, and when you're going in to discuss this with a new investor coming in, and you want to kind of say, if it's going to dilute me, I want that pool to be low now, and if we miss it, we'll have to increase it later. But think about justifying what are your hires and what are your option grants over the period that you expect the money to last. And if it's 18 months, then, you know, how many hires are you is in your budget for the next 18 months, and what percentages of equity are you planning on granting them? That'll help you figure out how much you need available.
Yeah, and Gabby, when with these new laws going on and you're recruiting, how much are people asking these questions? How much do you get into this discussion with a candidate?
Well, the new laws going in California and in New York and places like Colorado is that you have to post salary for any job posting or any position specification. It has to have a salary range on it. You do not need to talk about bonus or equity from my understanding, at least right now. The prior pay transparency law that we've been living with for the last couple of years is just that you're not allowed to ask employees what their current compensation is. You can only ask about their comp expectations.
Right. So I think it's more important now. Mark, go ahead. Yeah.
Yeah, I was just going to say I think there are maybe 16, 17 states or municipalities now that have put that in place. I guess California and New York, and in particular New York City, has its own local law, and so that's driving a lot of, I think, these questions about how it works. But one thing to just remember, because I expect our audiences from all over the country, that as of right now, it's still only 16 or 17 states and municipalities that have implemented these, and they're different in each state. So it's not a overall uniform law.
Great. We did have a question come up asking about changes, any vesting schedules, since there's obviously quite a bit going on with dilution and underwater stocks. So have you made changes to vesting schedules? And 94% of private companies are here, of the 125 in the sample size, which I think is a good indication, are saying no. So things are being very consistent in terms of how the vesting schedule is staying 4 years. And then we did have I think we're talking about the refresh program is always very helpful. Like, so do you have an evergreen program to grant follow-on options? And the reality is that yes, companies do, but the other reality is that it's really dependent upon whether you got your starting point right. So if you're refreshing because someone was low to the market, or you're refreshing because someone's fully vested, it really is on a case-by-case basis. In addition to that, how often you refresh, again, it says as needed. I think it's really important to understand that the whole narrative around this is really depending on how good of a job you did from the beginning. I'm going to move on.
I would just add real quick, I always view it as kind of two categories of refresh grants. One category is you granted at early stage companies, you grant people options, and then they grow either out of, in a positive way, or out of, in a negative way, their position. So, somebody who maybe had a smaller grant is now, she or he has proven himself to be, a more valuable player and has moved up to a CXO level. The grants are out of whack then. Alternatively, somebody may have moved down, the grants may be out of whack that way. The other category is dilution, financing rounds. If you're not refreshing the grants, then the percentages can get out of whack that way too.
Yeah, and that's so important to not have it get out of whack. I mean, right, Christine, you're a whole of the, know what you own and how you own it. So if someone is, fully vested in trying to figure out when they should be purchasing these options, I mean, that's all part of the modeling, right? And tied into what Mark is saying, how long is the money going to go? When are you going to have to, raise more capital? And that all impacts someone's clock ticking, right?
Yeah, exactly.
Mark, you touched on a very important point, and that is, Christine, what's going on in the IPO market? It's pretty quiet, right?
What IPO market?
Right. So
it's going to be pretty dry for a little while, right? And I don't know, Mark, you can probably jump in on this, but short of that, you're probably going to see a lot more M&A fill that hole for a little bit, which actually does need to happen because there's so many companies, especially in the biotech side, that are out there on the public side and private side looking for funding, and then the public's pushing into the privates. So there's got to be a little bit of consolidation and or dropouts there, right?
Yeah. I mean, we're seeing increased M&A activity across the board. We are seeing, I mean, haven't hit the markets yet, but we are seeing some companies that are looking to go public, waiting for the markets to come back, hopefully. But I think people are optimistic about that for next year.
Yeah, and Gabby, what are you seeing with companies? People you see, I know you've seen movement from the private to the public and the public to private. So what are people's questions as they're moving from one to the other, mainly from the public into the private?
Yeah, I mean, I touched on it before. It's really about cash runway and how much money the private has raised to make them feel more comfortable making that move, to make sure that there's frankly money in the bank to do the build, and they can get their feet on the ground before they need to raise money. People don't like to start and immediately have to start fundraising, although in this market, sometimes that is the case. On the IPO side, we are seeing a lot of our clients that are hopeful that early next year, first quarter or second quarter, that they will be able to go public. And we've seen some get through, but I think the headline is that you have to be at least clinical stage and further along. The very preclinical companies that are more exciting platforms are going to have to wait a while. Unlike the last prior years where we saw a lot of those companies get through.
Right.
So Jody, let's go back to some more of the data, if we can kind of go through, especially in a environment right now. And there's a question on this too, just as we look at, it's kind of a tale of two cities. We've got massive inflation. And so there's kind of cost of living, cost of labor, like how are companies thinking about this going into year end?
Yeah, so we're looking at the year-end merit increase results. We did a preview again here. So this is the salary increase for the coming year, right? So this is real time. This was just pulled earlier this week. And again, I want to make sure, though, this is predicated on the fact that everyone understands that the compensation data, the starting point, is also very relevant, right? So depending on where your total cash was to begin with, or your base pay was, that would be the salary increase would be on the base pay. What we're seeing is a higher use of the 75th percentile and max numbers, and the 75th and max numbers have increased. So you can see here that salary increase for the coming year, the yeses obviously are pretty high, and the no is the smaller end. But again, these folks might have been at the higher end who have the no. So it is on a specific case-by-case basis to understand this has to be taken in context. And then here's salary increases a percentage of salary. And you can see, so the 75th percentile, right? The 25th, 50th, and 75th. So that 50th has been pretty consistent around 5% year over year. And this is for 2022, but the 75th percentile is up. And I mean, Gabby, I would think that you're seeing people wanting pretty competitive, high-end comp packages, as you were saying, to come into, especially coming from the public to the private.
Yeah, absolutely. We're not seeing that go down. We're seeing that increase. I think the biggest issue that we've heard from a lot of our CEOs is frankly the cost of living increases for the rank and file, and how that is, that's been challenging to figure out.
Yeah, so this is the salary increases a percentage of salary for the financing categories. So these financing categories where maybe you had, been a little more tapped down on the total cash for the base salary because you gave more equity, and then you get into that 15 to 50 million, and all of a sudden you've got to up the total cash and the salaries because you see that you've got runway, and you've got to make sure that it's competitive. And folks now are definitely feeling a little bit of a pinch from the prices going up. And here again, salary increases as a percentage of salary less than 50 million and 50 million plus in total financing. So these 50th percentiles and the 25th percentile is pretty competitive and stable, but the 75th percentile is what's shown a real peak here. And then we're seeing also for some other key jobs, CSO, same thing. And then here the CSO. So you're seeing consistently, which is what we wanted to show you. On the staff level, let's see, here's CTO. Same thing, right? Exactly what we said. We're seeing these 75th percentile numbers are what are jumping. And then here is CTO. sample size of 5, but we figured it'd be good to show you. And then on the executive comp, let's get into, we had a couple other slides just to show you. Here's the total cash biotech versus non-biotech. So the biotech folks tend to make higher on cash, and this is just for the median 75th by, not by financing. So that sounds pretty consistent with what you're seeing, Gabby. So the numbers, I mean, this again is meant to give you a sense of what we're seeing in the market, and got to break these down a little more specifically depending on your company, who you are, and also where you are in your financing. And then the non-biotech CEOs total cash a little bit lower. And then here's tech. I know we started with this one, but I'm going to show you by gender, just as an aside, to see that, women are definitely on the tech side, and the total cash, 25th percentile, the same, the median a little bit lower, 75th percent lower, and the maximum numbers lower. But the equity, we see this over and over and over again, that women are consistently going for a little higher on the equity and a little lower on the total cash. And I guess my recommendation, I just did a webinar yesterday with women in venture, and the venture data shows the same thing, that women are very long game oriented. I don't know, Gabby, if this is your experience. Hopefully the new laws are going to help have higher transparency. But I wish that women would go ahead and push for the cash in addition to the equity, because we do see that that's what men are doing, that they are, or the marketplace in general, right? That there doesn't have to be a trade-off. You can go for, if you're an A gamer in talent, then you should be pushing on both. I mean, Gabby, I would think you would see less of this because you deal with life science companies, that women are pretty capable of requiring what they need.
Absolutely. You just said it. So yeah, we've seen, well, I think what you said is that, yeah, they should be negotiating on both ends. That being said, frankly, the equity is where it's at. And so you should try to get the most equity possible if you believe in the company.
Yeah, but with this is the life sciences, and why we see that with women, that they haven't taken as much of a compromise is, by the time you're the CEO of a biotech company, regardless of who you are, you're very well educated, you've had a lot of experience, you're used to negotiating, and you're not really putting yourself in a position to take less. So you can see here, and again, this is not broken, this is the under 15 in total financing. So you can see the total cash for women. The max numbers are a little bit lower, but otherwise things are, mainly competitive. More so than anything, we just see the sample sizes are smaller for women, versus a big differential in terms of the total comp. I want to be sensitive here that we're coming into our last 5 minutes. Here we showed the median, here stayed the same, regions where that stayed the same. I'll show the CSO data just to give a quick, and everyone's gunning for comp data here. The CSO for across all industries, right? Always interesting to me now that we're doing that. It's just not life science oriented. And that the total cash, and again, that I would think that 600,000 is coming up to a more late stage company. And the equity, though, big dip down from where the CEO is. The CEOs tend to that 5% on average, and that the CSO is the next level job. We did have a question about CFO. What are you seeing in terms of CFO levels? I don't know, Gabby, are you doing much recruiting for CFOs at life science companies?
We are, because there are some people that are optimistic about next year and need a CFO to help them take them public. What we normally see in this market is a dip in CFO and an increase in CBO searches, because those CBOs, are good at negotiating partnerships that can bring in non-dilutive financing. We haven't seen as big a spike in that as I would have expected.
Yeah. I'm going to move into, I know we want to talk about I want to move into change of control and severance, because Mark, I think this is a great area to talk about sort of single trigger, double trigger. Here we go, accelerated vesting. So maybe you could just touch on this. I think it's an important part of an employment agreement, or coming in to understand what happens through a merger or acquisition, how this, what happens with accelerated vesting.
Sure. Yeah. So as we mentioned before, your shares may vest over time, 1 year cliff, monthly over the next 3 years. What happens if there's an M&A event that happens before all your shares have vested? Do you get accelerated vesting, meaning everything's vested. So at the time of the change of control, you own all the shares, whether they're vested or not. Single trigger would mean that single trigger acceleration means at the time of the change of control, you're basically fully vested, and then you can walk away after the sale happens because you've just received all your consideration. Double trigger would mean that there has to be a change of control followed by something else, usually 12 months staying with the buyer to kind of transition. There's also a hybrid trigger, which is maybe 50% of it might vest on the change of control event, and then you have to stick around for another 6 to 12 months to get the rest of it to vest. But I guess your data is
it always surprises everybody that shows almost 50-50 on this, but it does, and this is like the 6th year in a row. I think here's the CFO, if that helps for those of you that wanted to know about CFO, because it's usually, Gabby, is what you were saying, is a very attractive job, especially for a later stage company. So the CFO also has accelerated vesting of equity in the event of a change of control. And here the CFO acceleration, again, 100%. So that's sort of what you're going towards. And of course, probably the same for a chief business officer. I guess it's just more so to be mindful of this, because it is something that should go into your compensation package as if you're coming into a later stage company. Gabby, how often are you seeing?
I would also just say it probably makes most sense for the CFO and the CBO roles because they're redundant, if you will, right? So usually it's to incent them to stay on to the next round with the acquiring company. And so usually with a CEO, you'll see that double trigger because you really want them to stay. With the CFO and a CBO, it's pretty redundant in terms of jobs. So you kind of want to give them that accelerated vesting upon change in control.
Right. And someone else asked about this question as well, sort of retention incentives. If there is some kind of transaction during an acquisition, and it's almost at every case, this is a check all that apply, but main thing is money. Everybody needs to be incentivized to stay. And obviously it's sort of like a double-edged sword, because the reason you get into a private company is because you want the entrepreneurship and the creativity. But in order to stay, when the landscape has changed, you need to be incentivized. And these are the kinds of things that you really just can't control what's going to be the exit. But we're seeing M&A activity is more prevalent now than the IPO market. I'm going to turn it over to Christine to wind us up, and thank you all for joining us. And you can see there's quite an integrated, holistic part here for compensation, right? We will follow up with you, all the attendees, and send, again, the recording and a link so you can get on, because we'd love you to participate. Everyone does get access to a no-charge platform, which is a subset of the data, so you can see what's going on in the J.Thelander world now that we're all in one place. And we would value your participation. Also hope that you find the no-charge data to be helpful. Christine, turn it over to you.
So that's pretty much it. I would just say a big thank you to all of you that took time out of your day for joining. Sorry about the little bit of tech challenges in the beginning. Zoom is tired. And we hope to see you all in person sooner rather than later. But again, a big thank you to my fellow panelists. There is a lot of fun stuff, whether you may think it's fun or not. We can dive into it, into the data, into the details, and we're always available to answer additional questions. But thank you all for joining.
Yeah, we'll provide contact information for Gabby and for Mark. And Mark, thank you to Gabby, Christine, always my partner in crime here. Thank you.
Bye.
Thanks, everyone.